And welcome to Your Finance TV. We're here with Jeffrey Hughes, founder at Alpha Insights. So Jeff published his weekly playbook on Sunday night, which is when all of us were watching the Super Bowl, but he was working hard and he pushed it out. So, go check it out on Substack at hugeinsights.substack.com. Jeff, welcome back, mate.
Thanks for having me on the show today, Mehdi.
So, hope you enjoyed the Super Bowl. A lot of turbulence in that game towards the end, and I think we're starting to see some of that in the market as well.
That is true.
Well, without further ado, Jeff, why don't we kick off as usual with the top down?
Sure. As all will know, last week we pushed up to a fresh new all-time high. The S&P was up 1.4%. But this week, it's Tuesday today, Tuesday afternoon, and so far we've given back last week's gains. Yesterday, Monday, we made a new intraday high, but closed below Friday's high. That's significant, and you'll find out why a little later, based on the title of one of my slides. But all said, Mehdi, I mean, we're more than halfway through, maybe 60% of the way through earnings season. The results are coming in slightly better than dramatically reduced expectations going into quarterly report. My assessment of this is that the guidance has been a lot worse than a lot of people think, and you can tell because the market has become exceedingly concentrated. Just four stocks account for 50% of the S&P 500's year-to-date performance. So that level of concentration exceeds what was seen at the dot-com peak, and it is concerning, no doubt. The other thing I would say is that we got a lot of economic data coming out this week. We began this morning with the CPI data, and it was hotter than expected. And so I think that's probably the catalyst, obviously, for today's sell-off. And going into the print, I think nobody really wanted to be excessively too far over their skis anyways. But it tells me that this higher for longer mantra that the Fed has maintained for some time should not be ignored. And Powell should be taken at face value that they do not feel that they're compelled to cut rates in the first half. And we've already seen the first cut pushed out to June in terms of the market's probabilities, pricing it in. Something like just barely 50% are now looking for a June cut. So that is a big change. And we've seen the 10-year bond yield back up here to, close to 425, 427. I think we got to today at one point. There's a lot going on here, and the stock market is really being held hostage by, its addiction to policy support, its addiction to low interest rates and added liquidity. And every time it hears that there's a possibility for more of that, they bid it up. So that being said, I think, the economy is a lot weaker than what the headline data would suggest. And, we continue to have a lot of skepticism about the soft landing narrative and new bull market that has been embraced by the consensus. And, we'll discuss what we think is what our outlook is for the market going forward. But I'll just tell you this, we end every Sunday night note with a recommendation for clients about committing capital. And our capital commitments are as follows. Minimize net equity exposure. We're big advocates of market neutral right now. We also think 3-month treasury bills are the best deal in town. Even at 5.4%, down from their recent highs, you're getting 2/3 of the market's long-term historic return with zero risk. And I think that the odds are moving further and further away from Fed cuts at this point. So you'll be able to continue to enjoy those returns for longer than a lot of people were thinking just a few weeks ago.
Thank you for that, Jeff. So let's dive in a little bit deeper. You also talked about the concentration in the market and the performance so far. So let's have a look at the returns for the major market indices this bar. And you're talking about now the Fab Four away from the Magnificent Seven. So they've certainly been leading the way versus their peers. So talk us through this.
Absolutely. So as I mentioned, there's four stocks: Nvidia, Meta, and Amazon and Microsoft. Those are the four stocks. They account for over 50% of the S&P 500's year-to-date return. Tesla's been a disaster. Apple has underperformed, as has Google. And, I think the Fab Four are really the way to look at this, or to approach it kind of, and then there were four. Because they're just dropping out one by one here. And which, what stock's going to be the next one to drop? I think it's going to be Microsoft. I think the dreams and hopes of investors for this massive incremental revenue being generated by, generative AI is really just, it's too early. Okay, I think that is a conversation for several years down the road here. We're just in the very, very early innings, and I don't think we're going to see the level of contribution from AI investments start to hit bottom lines for some time to come. That being said, if we take a look at how markets have performed, you can see that the NASDAQ 100 has been the leader with over a 6% return. The S&P 500 is not far behind, as that core concentration of stocks. The top 10 stocks account for 40% of the S&P's market cap. The top 100 stocks are 70% of the S&P's market cap. Here's a little known fact. If you were to take those top 100 stocks, go ahead and calculate what the forward 12-month PE is on those, and just take the straight up average, it's 25 times. If you took the index contribution weighted average, it's 27 times. That is an extremely rich valuation, exceeding even what the S&P traded at the dot-com bubble. And by the way, those top 100 stocks account for over 70% of the S&P's market cap. So, what's the average stock done since the beginning of the year? Well, the average stock's up about 0.6%, and it's probably down because it's not including today's terrible performance, which we're down over 1% on the S&P 500. I'd say the average stock might be negative year to date at this point. T-bills are positive. T-bills are up, better than 0.5%. And so, through Friday's close, the average stock had only narrowly outperformed. I think that there's one noteworthy place to focus our attention, and that is the simple fact that the regional bank sector ETF is now down some 9% or more. Much of this has to do with a bad earnings report from a inconsequential player. I don't even think it's in the index. I could be wrong about that, but I'm pretty sure it's not. And that's New York Community Bank, a very small bank, only $100 billion in assets. They wrote down 2 commercial real estate loans. One was a co-op. The other was an office property. They took a $185 million hit on those loans and had to reserve 10 times the amount that they thought they were going to have to. And they missed earnings by 193% to the downside. That negative miss sent the stock reeling. That stock was down 60% in 5 days. I think it's maybe at a new low right now. And, it sent the regional bank index down about 9%. So even Powell's comments and comments from various Fed governors last week suggest that there is an expectation for another mini banking crisis later in the year. But, Powell said that it's quote unquote manageable. That remains to be seen. I think that they know what they're going to do. They're going to throw another $400 billion log on the fire, and all the bulls are just salivating because they think, oh my gosh, that's going to send the market up, dramatically again. And it might not work this time. We'll see. Barry Sternlicht, was out in a Bloomberg interview a couple of weeks back, and he indicated that he thought there was something like 1.2 trillion in losses in that asset class. And the real issue is nobody knows where they are. Nobody was expecting this, New York Community Bank write down. That was a total surprise, a shocking surprise, in fact. So I think there's a lot more of that to come. And so we should all be very, very cognizant of what the average stock is doing relative to what 2 or 3 really, really powerful performers are doing in their influence on the broad averages.
So, Jeff, another one of those large influences within the market and part of the Fab Four is NVIDIA. So NVIDIA obviously had a phenomenal year in 2023. It has certainly kicked off the first 6 weeks of the year in true same fashion, and this is a crazy statistic that you've shown. Nvidia's market cap is now exceeding the entire market cap of the S&P 500 energy sector. That's crazy, Jeff.
It is, and it isn't my work. It's the work of Charlie Baleo, and a lot of people probably follow him on Twitter. And every now and then, his insights show up on my Twitter feed. When I saw this, the first thing that went through my mind was, "Oh my God, it's March 2000." I remember when Cisco Systems traded at like $78 a share, and its market cap was just under 600 billion, and people were going to be like, it's the most valuable company in the world. It just etched out Microsoft with like a $587 billion market cap. And then someone else pointed out that the value of Cisco Systems is now greater than the entire global automobile industry, which back in 2000, the automobile industry was kind of it. That was the biggest industry in the world, right? So it was kind of a shocking revelation. And of course, we all know how that ended for Cisco shareholders. To say not good is to kind of be the kind way to put it, right? But at the end of the day, I mean, NVIDIA's $1.8 trillion market cap exceeds the entire market cap of the energy sector in the US, ExxonMobil, Chevron, all these other companies. And there's a lot of M&A going on. So that sector is actually likely to balloon up a little bit as they acquire some of their smaller competitors. At the end of the day, though, I think we have to realize that what we have with NVIDIA is a company that designs high-powered chips that are made in Taiwan, okay? The company doesn't, it's an asset-light company. So there really isn't anything there except for, a spreadsheet, an Excel spreadsheet that says that these guys are going to make $21 a share in 2025. That remains to be seen. I think something like 90% of their production is in Taiwan through Taiwan Semiconductor. And Taiwan is an area of geopolitical stress. And this is the year of the dragon. If I'm, Xi Jinping, am I going to wait till 2027 when my military is up to the point where General Milley thinks it needs to be in order to take over Taiwan in the year of the goat? Or am I going to do it in the year of the dragon where I am powerful, right? It's the most important symbol in Chinese culture. I don't think he's going to wait till 2027. I think if one were to take a look at the amount of military activity taking place on a daily basis since the Taiwanese presidential election on the 13th of January, it is unprecedented. And it's gotten to the point where it's so close to an act of war that it's actually impossible to differentiate what's happening on a day-to-day basis with what would happen if an actual attack would go on, which now has the U.S. dispatching 2 aircraft carrier strike groups to the region. And that there were serious military exercises as recently as 7 days ago, just in the just outside of the Philippine Sea, which is in striking distance of the Taiwan Strait. So there's no question that the U.S. is positioning themselves for an attack, but nobody's talking about this, right? Well, if in fact China were to just engage in a naval and aerial blockade of Taiwan, that would shut down all incoming goods, right? That would necessarily be the inputs to go into semiconductor production, and then there would be no exports of semiconductors, and so the entire world's economy would basically come to a halt. And that $20 earnings estimate for NVIDIA is nothing but a fantasy. Okay, so I don't think that it's necessarily a justifiable statistic at this point. But I digress.
So, Jeff, you've got an interesting one in here at the moment, the Hindenburg omen, right? And initially, I kind of thought, is this from Breaking Bad? But then that's Heisenberg, isn't it? So I'm completely off track on this one. But Hindenburg omen, and it does certainly feel like this omen's looking a little ominous. So talk us through the Hindenburg omen.
Yeah, so there's a guy named Jim Mika. He's actually passed away a number of years ago at an early age of 54, in a tragic accident. But Jim was a mathematician, and back after the crash of '87, he became very, very interested in trying to identify a systematic or formulatic approach to understanding when the stock market was poised to experience a dramatic shift in trend, okay, like another stock market crash. He wanted to come up with a predictive formula for that. And what he, after exhaustive research and analysis for years, he actually came out with a very simple system. Number one, it's all based on NYSE data, by the way, only NYSE data. And so Jim's formula was essentially that the NYSE had to make a new 50-day high. So the price of the NYSE had to be higher today than it was 50 days ago. The second criteria was that new 52-week highs and new 52-week lows must both simultaneously exceed a threshold of 2.8% minimum of all outstanding issues. Okay, what that means is that there is a tug of war going on between bulls and bears, right? And then also the NYSE breadth must break to negative territory. He used the McClellan oscillator as the measure of breadth. And so when the NYSE version of the McClellan oscillator goes negative, breaks zero, that confirms the third criteria necessary for what became known later as the Hindenburg omen, named after the famous Hindenburg Zeppelin disaster of 1937. And so why did they call it? Well, Mika's model was very consistent. It identified the 1994 problems in the market. It identified the 1997, 98, 99, 2000. The Hindenburg omens were flashing like crazy in 2006 and 2007, preceding the great financial crisis. It's had a terrific track record of identifying this. But now what they've actually done, and this is it posthumously, they've taken Mika's data sets and they basically taken the formula and applied it to the NASDAQ composite. And someone created a NASDAQ version of this. And, looking back over, the back tests of this, it looks like empirically, when both of these measures, both NASDAQ and NYSE data, are flashing Hindenburg omens, you have a higher degree of efficacy. And so what did we get? On February 8th, we got a Hindenburg omen in both the NYSE and the NASDAQ for the first time since November of 2021 rather, which was when the NASDAQ 100 actually hit its last all-time high prior to this breakout. And so it suggests that, we should probably pay attention to the symbolism of this indicator.
That's great. Thank you for that breakdown. So, Jeff, excuse me, we've obviously had new highs, and I know you published this on the weekend, so it might have been a different conversation yesterday as opposed to today being Tuesday. But have we hit a new high of late, and have we topped? And obviously, I think you might be feeling a little bit more confident as the market's looking today.
Well, let me put it this way. On Sunday, when I was writing this, I looked at the closing price action of the S&P 500 on a daily basis on Friday, and I said, you know what? It still could move a little bit higher, and I calculated a price target of 5,032. And we were below that. It was I can't remember the exact number, maybe 5,012 or something. But I said with a question mark, was Friday the high, right? Thinking that maybe we could go one more. I'd also point out that Friday was a minor Montgomery cycle turn date. And oftentimes those come with a plus or minus one trading session. Well, I think it was a plus one because we got a new intraday high. We got up to 5,048, just 16 handles above my target intraday, but then closed below my target. And that lower close, even though we put in a very long wick, if you will, on the candle on Monday, it looks like Friday's closing high was the all-time record closing high thus far. And now we've seen, a rapid decline of some, 1.5%. in the S&P 500, and I think it's the beginning of a corrective waveform that could build. Okay, so what we said in the note is that it looks like there's a high probability that the S&P is topping, but not just in this final little 5 waves up, but it looks like it's 7 degrees of trend, and we've counted it from minuet, minute, minor, intermediate, primary, cycle, and super cycle degrees of trend. Okay, and we've got it all inked out there. And our belief is that this probably is the end of super cycle wave 3. And if we're right about that, we are beginning this very day what will likely be a 10 to 15 year process whereby the S&P 500 retraces a significant portion of its 92-year advance off the 1932 low that carried the index, from a low of like 83 on the Dow to 38,000 on the Dow. And my suspicion is that is going to retrace, say, somewhere around 1/3 to 2/3 of the total decline. Now, we are at super cycle degree of trend, and things tend to be bigger. And if you take a look back at the 1929 to 1932 period of time, that was super cycle wave 2 decline, and that retraced 78.6% of super cycle wave 1 up, which topped in September of 1929. And so our thinking is that if we were to see a 78.6% retracement of the entire advance to yesterday's intraday high, it could carry the market down to something around, call it 1,200 on the S&P 500. So we could lose, something like 75 to 80% of the value. Now, there's a lot of reasons why that might be possible. And I would point to the debt as being the overhang on global growth and the U.S. growth. And I say global growth because the U.S. is the engine of global growth. But if the U.S. has trouble growing because its debt to GDP exceeds 120% like it is today, and it appears poised to grow to about 180% of GDP in the next 30 years, and the deficit is currently 6% last year, expected to be 7% this year, and according to research from the Aspen Institute, is expected to grow to 10% over the next 30 years, it's going to be really, really difficult for the U.S. economy to continue to sustain the pace of growth that we've experienced over, say, the last 3 decades. My suspicion is that is going to go by the wayside, and we're going to have a massive correction or reset with financial asset prices, and that's where we're at. And so, we've drawn the lines, we've labeled the charts, we've put out our views. We've been early, okay, and early's wrong in this business. So, we look like a joke out on the street with our view. But, at some point down the road, the chickens are going to come home to roost, and that day might be today. And as that process, and it is a process, unfolds, we're going to look awfully right down the road. Sometimes you got to look wrong for a little bit in order to be right, because you can't get out at the exact top. A bell doesn't go off at the top, but it might have this time based on the data that we're looking at. The other thing that I thought was interesting is, investor sentiment has really reached kind of a new crescendo in recent weeks. We got to this 102% leverage on the name exposure index back in late December, but the latest rally up was short of that, Mehdi. It only got to about 95% or just shy of 95%. So that constitutes a bearish divergence. We saw the same thing occur in the AAII individual investor survey, where we got up to 32% bull-bear spread. That was the highest we saw in 3 years. And now we're making a lower high around 26.5% or so. And again, we're seeing a bearish divergence. These bearish divergences tend to precede a major trend change. And so we think we're there. Perhaps today is the beginning of it. Perhaps there's one more move up, but we're in the very, very final innings of this. In fact, we're in extra innings. And I'm pretty convinced that the top is in. and I would position for that going forward.
Jeff, it's been a long time coming to this point. Over the last several weeks and months, we've had these discussions, but it's all feeling very, very tenuous. So thank you for that breakdown. So, Jeff, let's have a little look at sectors now. I know we've spoken about the Magnificent Seven, what are we calling them? The what four? The Fab Four, the Fab Four. But there's obviously a heavy leaning towards tech. So, tech's definitely leading the charge here, right?
Yeah, that's absolutely right. And in fact, last week we saw, well, 2 weeks ago, tech was missing in action. We had, we labeled the chart, "Where's Waldo?" Where is tech? It was nowhere to be found. It just, it was an indistinguishable move. And then, of course, last week, tech leadership, reasserted itself and kind of took over. And what we see is that, tech remains kind of this big contributor. Communications remains a big contributor. Healthcare surprisingly has been a big contributor this year, and so we can't argue with the fact that tech is adding a lot of value to the index itself. All we can do is warn you that it's risky at this point, and so what we really want to do is try and de-risk our portfolios. If I'm a portfolio manager right now, looking at valuations, looking at where we are in the cycle, and looking at my P&L based on some of the moves that we've had in these big stocks, I'm looking for ways to de-risk going forward. And I think the first thing that I would do is start to take some profits in tech and rotate to sectors that still have growth, but maybe don't have the valuation risk that seems to be associated with some of these high multiple stocks.
So then, in that case, Jeff, it's perfect kind of segue into me wrapping out with not positive, but something to put our money in. So, based on a valuation basis and a relative strength basis, how would you look to position yourself in sector wise?
Yeah. So, from a valuation perspective, the market seems to have this kind of bifurcation whereby, tech is trading at a 50% premium to the market and energy is trading at a 50% discount. But, energy, while certainly I think there's a value case there, there isn't a lot of relative strength there. There isn't a lot of catalysts, although we are seeing some M&A in the smaller side, but most recently it's come from the private side, public companies buying out private assets, to build their portfolios. And of course that can create value, but can also create uncertainty in the short term. And so, we've kind of combed through this a little bit, and it seems like the best, kind of growth at a reasonable price, if you will, comes from the area of healthcare. And we like healthcare for a couple of reasons. We think there's still growth there. We're still seeing companies like Lilly just coin money with their new drug, weight loss drug. Although Novo Nordisk isn't a U.S. company, there's outside of the U.S. there's plenty of opportunities there as well. But then there's also companies like Pfizer that are really kind of weighing on the healthcare index because they made their money off of vaccines and nobody's getting vaccinated for COVID anymore, and so that revenue stream's really dried up. But then on the other hand, you've got big drug companies like Merck. With their, miracle cure in cancer, Keytruda, which is, extending the lives of terminally ill cancer patients. You can't get enough of that, right? And so that drug is really driving revenue growth there. And then we've got, a lot of biotech companies that have new drug development programs that some of these companies, even Merck and Lilly, are going to be interested in acquiring. But certainly Pfizer needs to figure out how they're going to acquire their next leg of growth. And so, I think the biotech company is ripe for continued M&A. We've seen a number of transactions already in the last quarter or so. It seems to me that we'll see many more in the next couple of quarters. And so, I would not be surprised to see a couple of big biotech transactions announced. And then we've still got, a lot of medical device companies like Intuitive Surgical, the developer of the Da Vinci robotic surgical device. These companies are growing by leaps and bounds, beating revenue estimates by wide margins, right? And so, I don't think we can discount the fact that growth really exists in this space, despite a few bad apples, right? And when we look at valuations, we're trading at a discount to the market and a reasonable discount. And so I think you can still commit capital to healthcare from that vantage point. But finally, when we shift over to relative strength, really the only sector that is in the improving quadrant, pointed straight up, and looks like it's about ready to cross into the leading quadrant, both on the small cap and large cap side, looks to be healthcare. And so, relative strength is beginning to reassert itself there. And honestly, it adds a bit of a defensive component because, broadly speaking, when people think of what are the defensive sectors, well, yeah, it's utilities and staples and maybe REITs to a lesser extent, but it's also healthcare because it's not economically sensitive. It's a recession-resistant sort of growth. People don't defer spending on healthcare because the economy's bad, unless they lose their job and they lose their health insurance. But most states have stopgap plans where if that were the case, and then there's COBRA laws and everything else. So that's probably not going to be a factor, at least in the next 12 months. And so we continue to believe that healthcare has really just a lot of wind in its sails right now. We'd be looking to add healthcare exposure and rotate away from expensive, high multiple tech, discretionary, and communication stocks.
Jeff, great breakdown. Thank you very much for that. So as always, Jeff, really appreciate you sharing your thoughts from Alpha Insights.
Always a pleasure, Mehdi.
And I again want to make sure our viewers go check out your content. It was a Super Bowl Sunday write-up. Hugeinsights.substack.com. Thank you for watching, and until next time, good luck investing.